What a week in the markets here, and it's only Thursday, so I'm sure more to come. We are going to break down all that we've seen here this week, starting from Monday's craziness all the way up until today, and kind of why we're seeing a little bit of this volatility. We're also going to spend some time in our question of the week, very timely, and thank you, Tim, for sharing this with me, about how the Fed raising rates tames inflation. Like, why is that even a tool in the box, and what does that do for the economy? So we've got a lot to cover here. I'm Brandon Steele, financial advisor with Mainsail Financial Group. And our goal every Thursday is to bring to you the market news and data and trends we're watching, hopefully weed out some of the noise. So this week is just like full of everything. It's full of volatility. It's full of data. It's full of macro information. We're kind of all over the board. And so we are going to spend a lot of time talking about what's going on this week and why, from our perspective, some of this stuff is happening. I will start just by backing up a little bit and sharing some information from last week. Last week, we had another bad initial jobless claims, a terrible number there. So again, I know we talked about this last week, and I'm going to spend more time about the markets and what we're seeing today, but that initial jobless claims trend needs to reverse, and hopefully soon. It's the jobs market, supposedly, when you look at unemployment, looks good, but this is not a good sign of what, where that may be going. Anyways, this is like just the craziest week already. I'm sure if you guys have been following, you're exhausted. I know I am. On Monday, let's just kind of back up here. On Monday, markets started down 3.5, maybe even 4%, depending on the index you were looking at. It was an extremely volatile day. All that to say, at the end of the day, the market's actually closed about flat. Then we open up on Tuesday. We've got the same exact story. Market's down 3-4%, depending on the index you're looking at. Fast forward to the end of Tuesday, and the market's closed almost flat. Fast forward to Wednesday, where we've got Fed Chair Powell's conference, which I'll get into here in a minute. But we were all over. We were upside all over. Before Fed Chair Powell started talking, we were up 2.5%, 3%, depending on the index. And fast forward to the close of the market, almost flat. So it has been a crazy week. I mean, it's been all over the board. Volatility is certainly here. But what I want to share before I kind of get into the details of why this may be happening and what to get out of it is to really put in context that the truth is that this is healthy. This type of correction, which sounds like a bad word, but is good. It means that people are selling off their profits. It means that people are kind of reassessing. And if the market can continue to grow from there, it is a very, very healthy thing. This is a natural kind of phenomenon of the markets, right? It's supposed to ebb and flow. It's not supposed to be like we've seen the last 2 years where it is just up and up and up and up. So I think that, given that hopefully this bounces off of it, if it does, that this is a very healthy, very normal thing to watch. And, in a way, as weird as this may sound, it's kind of a good thing to see because we haven't seen it the last 2 years, really. And may have been due, especially with a lot of the like high flying tech that we've been talking about for a long time lately. I think that this is healthy. I think it's a good thing to watch. And I think that this is what happens when things get a little frothy is the market's got to reassess and say, well, what am I actually buying? What is this worth? And a lot of times what you'll start to see from here is the companies with strong balance sheets, the companies that are not just ridiculously overpriced, those companies tend to do well if the markets can pick back up. So something to definitely keep an eye on. And I wanted to share my perspective on that before we kind of jump into what's happening. But I think that what we've seen this week is a lot. It's a lot of that. It's just that broad perspective. It's people reassessing, but also a lot of anticipation for what the Fed was going to talk about on Wednesday, which I'm going to spend a lot of time on. And also to add a little fuel to the fire, a lot of these tensions with Russia, right? So it's hard to point at one thing and say, this is why this was happening. There's a lot of things going on. And again, I think a lot of healthy market moves at the underlying kind of, if you lift up the hood from this. That said, obviously, Russia tensions fueled it. Obviously, the Fed meeting anticipation fueled it. And so we had even more volatility than we might have typically seen. The reason that the Fed meeting anticipation is so important I think the Russia tensions is probably pretty obvious. The Fed one is so important, though, is because they're talking about raising rates. They're talking about slowing their bond purchases. They're talking about raising rates. They're talking about potentially selling bonds down the road as well. And all these things are a movement from a very, very, very accommodative Fed, right, boosting the economy, to potentially actually going the other way. But in the meantime, let's just call it at least a less accommodative Fed. So that's why we're seeing this. We haven't seen rates rise for a while. Last time they did it, there was the taper tantrum. So I'm sure that's still fresh in a lot of folks' minds. But that's really what we're seeing. In the midst of all this, maybe less important given what we've seen this week, but I do want to share on Tuesday, we had consumer confidence numbers come out. That number came out at 113.8. So considerably higher than expected. And it's interesting to see that given obviously what we've been watching here in the markets. And then fast forward to Wednesday, most important day of the week here for this week was the Fed press conference. It's the moment we've all been waiting for. It's the moment the markets have been anticipating. And I will say it did not disappoint. If you were paying attention to the comments afterwards or Wednesday at 11:30 or so, there was a lot in there. And I think the gist of it is that he was very back and forth. Like there wasn't a clear, this is what we're going to do. This is the answer to the problem. There's no doubt in our minds we're going to raise rates. That said, for the first time, I think he was a little bit more direct, right? It was that inflation's gotten out of hand. It was that the labor market is in a good place. It was that the economy is doing well. And so a lot of what he had shared certainly hinted at the fact that this is going to happen. We are going to raise rates, and it will be something that helps to tame inflation and something that they need to do to manage it. That said, within each of those breaths, he had also said, but we are watching the data, but we are seeing how things kind of transpire, but we are going to be nimble. And so I think that was the important takeaway from me. I think coming into this meeting, in my opinion, a lot of the expectation was that he is going to be very direct on what we're going to do. And I was curious if he was going to come out and say this nimble talk, right? Is he going to kind of hint that if the markets do what they're doing, although he will say that it's not market driven, from history, it shows that maybe it is. But basically that if the data shows that he may go back on the idea of raising rates, which was certainly a big part of the conversation. On top of that, they mentioned that in their meetings, they haven't come to a conclusion. They haven't made a decision. It's just that they are looking and likely to raise rates. He didn't say when, he didn't say how much, he didn't say how often. So I think that is a little bit of a takeaway and maybe a little bit of a hint at the fact that if markets don't appreciate it, don't like it, if things slow down, maybe this does or doesn't happen, or maybe happens at a slower rate. So I think that was huge in the conversation here on Wednesday from the Fed, and something very worth paying attention to, because that drives a lot of this, right? What I will share looking backwards is that a lot of times over the last couple of years here, as we've been dealing with this, remember that the Fed has kind of shared that they may do something and then the markets react and they don't. And so I think that that's something to kind of pull back on, and think about a little bit as we look forward. We'll see what's to happen, but certainly looking backwards, when the markets have disappointed or gotten nervous when there was conversations of raising rates, those types of things, they haven't panned out. So will that happen? Who knows? But something to keep in mind. All right. So I guess, this week, all that to say is volatility is here, right? Coming up next week, we've got inflation data coming out, spending, income, and jobs week all together. So we will have plenty to touch on next week as well. But let's jump into the question of the week. I want to thank you again, Tim, so much for sending this out my way. The question of the week is great and very timely. The question is, how the heck does the Fed raising rates tame inflation? And I think it's a very, very good question. And obviously something we're all paying attention to right now. The easiest way that I can kind of put this is that the Fed, one of the tools in the Fed's toolbox is raising or lowering rates. And generally speaking, what interest rate movements will do is to either stimulate or slow down the economy. So as weird as this may sound, essentially what's going on here and why the Fed is talking about raising rates is because it would slow down the economy and therefore the velocity of money and therefore inflation, right? So there's a few, like it's kind of like a domino effect, I guess, if you want to think about it that way. But really the idea is that when the Fed does raise rates, it slows down the economy, that slows down spending, that slows down inflation is the gist of it. On the flip side, what you've probably noticed over the past few years is if the Fed wants to stimulate the economy, they will lower rates. It means money is cheaper. It means money flows faster. It means that things pick up and there's a lot of economic growth. So we're just kind of on the other side of that equation, if that helps to kind of give you an idea. And I think one of the key things I want to touch on here is that the Fed raising rates 0.25%, whatever it might be, may not be the ultimate factor in this, but it's the rest of the interest rate market. So for instance, the 10-year, when the Fed announced this and started talking on Wednesday, the 10-year went through the roof, 10-year treasury yield. So when the Fed raises rates, what can happen is the rest of the bond market can be a little more free to actually price the way it should as a market, rather than being kind of held artificially low because of the Fed rate being held where it is. So I hope that helps. Thanks again so much, Tim, for sending that over. And if you guys have any questions, let me know. I'd be happy to answer them. Tim, keep an eye out here soon. I'm going to send you a coffee on me. So thanks again for sending that my way. We will see you next Thursday at 3. Have a great week, Intel, and stay energized with these crazy markets. We'll see you next Thursday.